Tuesday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor. Call your broker. That's what they're there for, to help answer your questions, give you advice. There's the disclaimer.
All right.
And let me share my screen. And I think what we'll do today, Will, is I had a question come up regarding implied volatility, comparing it to realized volatility.
All right.
So I think maybe what we'll do is go over that today. We'll take a look at some charts, see if we could analyze volatility from a few different perspectives, compare it to implied volatility. And we have a screener that can help you screen out stocks where the implied volatility is currently below the historical realized volatility or above. And that was kind of the question I got. So I'll talk about that today. If you guys have any questions, you could put those questions in the live chat. Will's watching it, he'll read them back to me. If anybody wants to come on a show and ask their question live, we also put out a link to Zoom. Click on that link, takes you over to Zoom. Once you get to Zoom, click on raise your hand. Once we let you in, you don't have to turn on your video camera. Everybody will be able to hear you, but you can navigate us to what you're looking at and ask your question directly. So those are two ways to ask questions. While we're waiting for questions to queue up, I'll start out with a pre-market report, and then I'll move on to a couple charts where we could take a look at the where the current volatility is, how it's behaving, where the implied vols are, and make a comparison. Sound good?
Perfect.
Okay. So let's start out pre-market report. These are stocks trading in pre-market hours. We have the most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, we have 261 stocks made our percentage gainers list, 44 on the decliners. From that perspective, we're looking like a bullish bias at the open. I'm going to filter down this list to look at only S&P 500 companies. We want to take out ETFs, closed-end funds, leverage products, preferreds. Let's remove all those, only focus on the S&P 500 stocks. To do that, I'm going to use this filter here in ETF. By selecting one of the ETFs in this list, the list below will get filtered by the holdings in the ETF, in that particular ETF. SPY, that's the S&P 500 ETF. We filter by clicking on it. I'm filtering out stocks that are holdings in SPY, and we could see here 66 stocks made our percentage gainers list, one on the decliners. And again, from this perspective, we're looking like a bullish bias at the open. We got a couple earnings coming out. I think most of the bank stocks are reporting. The big bank stocks are reporting. Goldman Sachs reported, Bank of America. Here's Goldman just now reported. So that's up 3.6% in a pre-market. I think this is State Street reported, up 3.7%. And they've so far been not so bad with their earnings. And a bright spot in their earnings is that if you take these big banks, they kind of split it up, the revenue, to interest revenue, non-interest revenue. And the interest revenue is doing really well. It's coming from a lot of deposits. They're getting a lot of people depositing money. They're paying a low interest rate on those deposits. but they're earning a higher yield on taking those deposits, and wherever they're putting it in, there's a wide spread right now, and that income has been exploding. Non-interest revenue, that, that's a mixed bag depending where you look. They're losing some places, gaining in other places. Looks like companies that are getting into the credit card, issuing credit cards, are doing pretty well, but not so bad. They look like they're diversified, and they do have offsetting revenue streams right now that they are doing well in. Let me move on to the volatility if there are no questions here. Let me see. Do you guys want to look at how so far the earnings reactions were?
Sure.
Let's take a look at that. I'm going to come under here, under earnings. And this is a report, and it's following in the third quarter we just started. The companies we are tracking, 81 that reported earnings, 57% of them so far were up after their release. So that day, after they released, on the day they were up, 41% were down, with an average gain of 0.3%. And we could see here that this is where we are here, third quarter. If we compare that to the 3-year average, a little bit better. So this is comparing same group of stocks. Let's take a look at S&P 500 real quick, and then I'll move on. So I'm going to take this filter here, look at SPY Holdings, reloaded. 29 stocks that we track reported earnings. 62% of those stocks after reporting earnings were higher. 38% were down. On average, gained 0.5%. And let's come down here. This is where we are here. 62% higher, 38% lower, for an average gain of 0.5%. And that's doing much better than the 3-year average. And this is, again, comparing the same group of stocks, these 29 stocks going back in history. You could see that how they did on average versus the most current quarter. So that's better, right? So far, it's been better.
We did have a question from Michael McCrae. He was asking, under stocks, earnings, interactive charts, he's asking, what is the look back period for the over-under estimate pie chart?
Let me take a look. So I'm going to go to Goldman Sachs. Under Goldman Sachs, under
Earnings, and then it says interactive charts, I guess.
Okay. This is a new feature, by the way. This is the first earnings that we have this feature, and you're looking at which pie chart?
He said,
this one.
He's asking, what is the look back period for the over under estimated pie chart? That's his question. How far are you looking back in the data? Let me know if that's correct, Michael.
Right. So in this chart, implied earnings moves, what this is looking at is the historical straddle. What was the straddle implying right before the earnings, and what did the earnings actually do? Overestimated means that the options overpriced the move. Underestimated that the options underpriced the move. We initially put in over here all the available observations, and here they are right here in the chart. This one's going back to Jan 14. What you're seeing in this chart is all these earnings. Okay, and sometimes we'll have more, sometimes we'll have less. Different reasons for. Usually it looks like this one is going back to 2014. Okay, so a lot of earnings. going back to 2014, you got 4 quarters in each one. You can narrow this down if you wanted to by quarter. For example, here's Goldman Sachs. If we wanted to look at only third quarters, I could click there, and everything in here will get filtered by historical third quarter. This is what it looked like in the third quarter, underestimated, overestimated. We could also narrow it down by years, last 2 years, 4 years, 6 years, or all available. Okay, that's basically how to use the filters above.
Awesome.
Hopefully that. Let's head to SPY, because I did want to touch on the volatility. I'm going to go for SPY. We're going to go.
Hey, D, your sound's coming in a little crinkly. Maybe move a little closer or try unplug in and plug back in.
All right, how's that? Good. Okay. We'll use SPY as an example, and let's take a look at first the realized volatility in SPY. And we can measure volatility in a couple different ways. There is no one method to measure volatility, and volatility is trying to measure the gyrations, the fluctuation in the stock. Okay. The initial 2 lines that we're seeing here is using 2 different methods. One uses the open, high, low, close method, and every day, it will take 4 prices, the opening price, the high, low, and the close, and run through a formula figuring out what the volatility was. And these are 20-day vol, okay, over the last 20 days. The close to close only uses the previous day's close to the next day's close. Only 2 prices, figures out the log returns, and calculates the volatility in the stock. When we look at these 2 lines right now, they're very close together. The way to read it is if they grow far apart. Let's say the open, high, low, close versus the close to close. If we see big gaps, it could mean a couple different things depending which way they're moving. Sometimes what can happen is that intraday we can see the stock whipsawing, but by the end of the day, the returns, it comes back closer to unchanged. In other words, we could go down 2%, up 2%. If it comes back to unchanged, the volatility on the day is low because there was no change, but intraday, it had whipsaw. When that happens, you will see a big divergence between the open, high, low, close and the close to close. If it's very volatile and the changes on the day are big, then these will tend to stick closer together. If the stock just moves up violently, from the previous day to the next day and closes there, then the open, high, low, close and the close to close volatility will tend to merge. Okay, remember this is a 20-day volatility. We're smoothing it out over 20 days. It's a moving average over 20 days. If the volatility behaves in a way where we tend to make big moves and close near the high or close near the low, then this red line will come above the open, high, low, close, right? And this kind of gives us a visual of how volatility is behaving, right? That's the red line, close to close, blue line, or green line, open, high, low, close. I'm going to put in a couple more lines in there to give us a little bit more insight. And this next one is the open to close volatility. And basically, it only looks, it takes out the gaps. Okay, it takes out the gaps and looks at intraday volatility. What happens if from the time the stock opens to the end of the day? Is there a lot of intraday volatility, or is most of the volatility right in the morning, where, like right now, you could see here, we're set to open up 2.2%. It's a huge move in the morning. And let's say we open up at 2.2% and we stay there the rest of the day. If we stay there the rest of the day, the intraday volatility will be zero, right? Because it does not move anymore. And that's the intraday volatility. So most of the volatility would just be at that opening gap. Let's look at the intraday volatility to compare it. That's this one, open to close. And here, that's the yellow line. And we could see how it's been moving around, and that's been trending higher with volatility. In other words, we are seeing a decent amount of intraday volatility, even after the open, even if we gap, don't gap, intraday volatility seems to be high. And that red line right now, from right here, I guess starting from here, October 4th, to me looks like it's suggesting that a lot of the times from that date, we tend to close either near the high of the day or near the low of the day. Okay, that's what the red line's telling me. That whatever the move is, the stretch, it doesn't just move to the high, come back down, move to the low, and come back into unchanged. It tends to keep moving and closing near the high of the day or near the low of the day. The other metric we could look at is the gaps. And that's from the previous day's close to the open. How much is it moving from day to day just from that morning gap? So we close one at one price, and the next day we open at a different price. And like today, there's a big gap, 2.2%. Let's see how that's been doing. And here we could see that it's ticking up for sure over here. It is ticking up right now from down here. So it kind of came in, those morning gaps came in around here, like dropped actually to the very low, and now it's ticking up. In other words, we are seeing a tick up in both the gaps and intraday. And I would say the intraday volatility is accelerating at a faster pace. There's more volatility intraday looking at this than there is, even though they're both going up, there is a bigger increase right now, acceleration in that intraday. So we are seeing a lot of volatility during the day. That's looking at the realized volatility. Just to save time, let's look at the implied moves. These are realized moves by end of day versus what the market was predicting a daily move the day before. Okay, these bars here, up and down, you could see we have them going back in days. The bar up and down is based on where did the implied volatility close, and based on that, we could interpolate the market's implied daily move. So here, I'm hovering over this bar. The implied daily move was up or down 1.9%. Yesterday, we were up 2.6%. That move exceeded the daily implied move, okay, average daily implied move. And when we see the red bar on October 14th, the day before, where the implied volatility closed, Again, the market was anticipating a move of 1.9% in either direction. We were down 2.3%. Again, that move exceeded the anticipated move by the implied vols. And implied vols, obviously, that's coming from the options. Wherever the options are priced, the implied volatility is the market's forecast of future volatility. And that's what we're comparing. Market's forecast versus the actual realized volatility day to day. Here we could see, I think, is this the CPI number, October 13th? So before October 13th, I think that's when the CPI number came out. We could see implied volatility ran up a little bit in anticipation of that move. And here we could see that the markets were implying 2.6% move in either direction. Market was up 2.6% that day. That's a kind of a visual here. If we come down here, we could see, given these last 20 trading days, which is about a month, on average, the implied moves were predicting an up or down 1.9%. The actual moves were on average 1.6%. Even though we had a couple of these breakthroughs, a lot of them were, by the end of the day, they finished within that range. On average, then, in the last 20 days, the realized moves, if you were hedging them end of day, were less than the implied moves. Okay, implied moves exceeded realized moves. However, out of the 20 days, 11 of the days, the move was within the range. 9 of those days, the move exceeded that range, which is, I would say, probably on the high end. Usually you see about, two-thirds of the days within, 1/3 out. All right, if there are no questions on this, no questions on implied versus realized moves, maybe what I'll do is show a screener of how to filter out stocks where currently the implied move is below the historical realized. Let me know if you see any questions.
None have popped up yet, D.
Okay. Let's take a look at this screener here. Options by expiration. And this is a list of symbols, and they're anchored by a particular expiration, okay? They could have multiple expirations here, SPY. You could see SPY alone has a lot of different options expirations. And what we do for each expiration, we capture the at the money implied volatility. These are at the money implied volatilities that correspond to this expiration. This expiration, June 30th, 2023, 177 days left to expiration. Implied volatility is 26.6. Yesterday it was down 1.1%. We also have the volume on that expiration, the open interest, and this is what the straddle premium is implying, the move between now and expiration. In other words, if you sold that straddle, the premium over the stock price is 17.7%. In other words, what you're betting is that the move between now and expiration will be less than 17.7%. If you're buying it, you're betting that the move could be greater between now and that expiration, if you held it all the way from now to expiration. This is the price of the straddle. And then if there are any events like dividends, earnings, whatever, we'll list it over here. I'm going to switch this tab here. And this tab will give us a little bit more details about the realized volatility in the stock. Here we see what the implied volatility is based on the option prices, and we could compare that to historical volatility. How much is it above or below the historical realized vol? And we could look at the 20-day volatility and the 1 year. In the last 20 days, SPY moved at a 27.3 volatility. And if we compare that to the at the money's IV, we could see that the at the money IV is at a discount to the 20-day realized. We don't know what it will move, but we can compare it to where it has moved in the past. That's a 2.6% discount to the last 20 days. If we compare it to the 1 year, we see that for the 1 year, it's at a 16.8% premium. And of course, I believe that as interest rates go up, we've been talking about it, volatility will tend to increase. Interest rates play a role in that, because as interest rates go up, you're removing liquidity, you're making forecasting models less predictive. It's already hard to forecast earnings. Earnings are the hardest things to forecast. Future sales, future earnings. It's not like a rent. When you rent a house, you pretty much know, you have a 1 year commitment from somebody to rent it, and the rents are kind of more stable. Earnings are not that way. They can move around a lot. A lot of factors come into play. And as interest rates go up, as cost of capital goes up, those become much harder to predict. And I think what we're going to see is a lot more volatility in the future than we have seen in the past with lower interest rates. Okay, keep that in mind. This, in the last year, the volatility that we've seen in the last year, in the previous year, the interest rates for a good part of it were still very low, 0, maybe a quarter of a percent. Going forward, we're going to be at potentially, what are we saying, 4% in November, Will? And now some people are calling that we might be close to 5% in the beginning of next year. Well,
You're absolutely right. I'm sorry, I didn't want to cause your voice to go underwater again. I think it's sometimes when I talk, we changes your mic. But yeah, no, these moving interest rates is a really big deal. And the market seems to be pricing it like it's going to have no effect, right? At the moment. I don't know if this is a bear market bounce or what, but people are starting to, dip their toes back into the market, right?
And we could see how illiquid the stocks are. These are very big moves. Even in the morning, what are we looking at? Pre-market above 2%.
It was 2% almost, right?
Almost 2% move on top of yesterday's, whatever, 2-point-something% move. Let's use these filters real quick, and I'm gonna just go to my default filter down here and look for implied volatility that's a discount to historical low. And oops, let me remove SPY here. A couple things here that I have said is that the stock price should be above $5. You know what? I'm going to move that to above 10, because I'm not looking for very low, cheap price stocks to trade options. Let's say stock price at least $10. Let's look for options with an expiration that has at least 10 days or more to go. Maybe I would even maybe take that up higher. Let's go out a little further, 15 days or more. Okay. And here we set the implied volatility versus historical 20-day. And this is set to that the IV, the current at the money IV, is 10% below the most recent 20-day historical vol. So the prediction of future volatility is at least 10% below where the realized volatility was in the stock. And that's what we have here. Okay, that's comparing this at the money IV to the 20-day volatility. So ACI so far at the money IV 28.4, but the stock has been moving at a 43.7. There is a caveat when you're doing this, and that is that some of these stocks, the implied volatilities could be low because there's a corporate action or a takeover or something that can make this volatility understandably low and justified. You'd have to look that up. If a stock is getting taken over for $20 per share and it's at $20, you don't expect volatility, right? You don't expect it to move around a lot anymore because it's going to get taken over for cash and disappear. And it's up to you to kind of go in there and do that research to look at what is the implied volatility low and is it justified.
Hey, D, I know we did the trading day just got started. We did have a question from Michael McCrae, though. Maybe we can carry over to tomorrow. He's asking, is the implied move based on the previous day's straddle? If not, what values are used to calculate upper and lower bars of expected move in this SPY example?
Yeah, in that example in SPY, what we're using is the 30-day implied volatility. I'm sorry. We're not the 30-day implied volatility. We're using the nearest term at the money IV. So whatever option expiration is the closest to expiring, the shortest duration. Looking at the money IVs, and sometimes it has 5 days to go, could have 4 days to go, 3 days to go. But using the at the money IV, we convert what is the expected average daily move from now to expiration. So it's not just it's not using the straddle like we do with earnings. Earnings is different because that is looking at a gap risk. This is looking at average daily implied move. So per day, on average, what is the market expecting the fluctuations to be in the stock?
Awesome job, Dima. We learn something new every day on this show. Great job, my friend.
All right, everyone, thanks for joining. Stay safe out there. Have a great trading day. And